It's funny, as an American moderating this session and faced with this question of, is fintech the next bubble? I looked at it and I was like, what? What's that question? I don't even get that question. But these people are all based in London, basically, or, well, more or less. And in Europe, the situation is so fundamentally different. And I think the challenge of this panel is that given that our audience is primarily American, and these guys are European, and the situation is so diametrically different because, and maybe I will summarize what we were discussing before. The EU has deregulated financial services to an extraordinary extent. And as they were saying now, if they can develop a business in London, they can sell the products in the Czech Republic. Whereas in the United States, as you just heard Jeremy say, in order to operate a financial services business here, you got to get licenses from every single state. So the US is a more fragmented market in financial services than the EU is, which is an interesting thing. So as a result of that openness, they've had this unbelievable proliferation of new companies and money flooding in, as investing in fintech, primarily based in London, which is something we really haven't seen in the same way here. So in London, it's a legitimate question, is there a bubble? Because so much money has poured in. Meanwhile, we have some pretty impressive fintech companies here and a lot of promising ideas emerging all the time. I think the general opportunity of fintech is massive, in my view, because the traditional financial services companies have two fundamental problems. One, people hate them, almost universally. And two, they have shit technology overall. And what they did was, because they digitized earlier, they have all these COBOL batch. A lot of these banks still are doing batch processing. That's a fact. And people want to, they want to transact in real time from their smartphones, and an awful lot of American financial institutions are incapable. I don't know if it's true in Europe, but I suspect the same is true. The large existing institutions are fundamentally incapable of serving, especially that millennial mindset of real-time, smartphone-based convenience. So fintech is obviously a gigantic opportunity. Now, what we have here are these three great guys that Dominic mentioned. Christian, who is an investor who is based both in London and Germany. He's been investing in the financial services for many, many years, even before it was fintech, traditional financial services, and now he's gone really big into fintech. Shachar, who is an Israeli guy who moved to London because of this openness that I was referring to, and he has this amazing company, Curve, which I will let him describe in just a moment, which is a classic consumer-oriented, well, I think he would argue it serves both sides of the fence, which is probably what he would argue. And Jack works for Wirecard, which is a back-end company, sort of like First Data, right?
The European version.
Yeah, European version of First Data that is a back-end for Curve, among others, a lot of cards, etc. So let me just start, since the question of the session is fintech the next bubble? Let's just quickly dispense with that. Jack, what do you think?
First of all, I hate the term, so just to clarify.
What, fintech?
No, bubble.
You hate,
I absolutely love fintech. Bubble I have a slight issue with. I think, and we were discussing this earlier, there's an awful lot of hype around this industry and this kind of space. There's a huge opportunity that exists because banks are making a pretty bad job of servicing customers for a long time. That's created opportunities to attack business models in all sorts of areas. And as a result of that, we have hundreds upon hundreds upon hundreds of companies out there that are in their own little niche, creating a nice story, are chipping away at the institutional banking model. I think that sheer volume of people, of opportunities, creates a lot of hype. And like anything, any investor will tell you the same thing. It's about distilling these opportunities down to what is real and credible. Who's building the best technology? Who has the best and cheapest way to get to customers? Who can combine the two of those? And that creates the real value. So absolutely no bubble, but there will be the natural kind of evolution of poor business models dropping away.
But I would just reiterate, we're at a completely different stage in that hype cycle. I don't know if anybody noticed, 60 Minutes did a piece on fintech on Sunday night where they discovered it. So, and then the New York Times business section today has a big fintech article. So, you know, we're just really starting to come on with, hey, fintech is cool, it's going to make the New York tech scene. So anyway, what about you?
Indeed, there's a lot of proliferation in Europe with fintech companies coming into place. We call it fintech. Most of them actually are payments companies. Unlike other companies in the startup space, the fintech space has unique characteristics where they're coming where banks were before, different products that banks had. If it's lending, mortgages, advisory, personal finance management tools. And the beauty about all these verticals is that because the bank took a lot of money before, you can create a huge value for the user by still taking some money, which is less than what he pays for the bank. So I can go to Lendify today, which is a US company, and take loans at better rates because this company has better data scientist that knows to handle my risk better, and I can already have an integral business model within the company itself. So fintech companies are characterized by having an integral business model, unlike other startups, and this is where the valuation comes into place. And immediately when the market sees high valuation, they have a question, is there a bubble? So there's a large proliferation of companies. Most of them won't succeed. There are very high valuations, but I wouldn't, as Jack said, call it a bubble just yet.
Okay, after Christian answers the bubble question, I want you to tell us what Curve does. And I want to come back also to this question later of how much profit there will be in fintech, because it's fascinating, because there's such disproportionate profit in financial services today. Presumably the number will be lower as a percentage later, but I'm curious what you all think about that. So Christian, bubble?
No, I see it like Jack. Like bubble is maybe the wrong word because it's just like it's too one-sided. I think it's like a tremendous opportunity for wealth creation. I think, by the way, more than in other internet sectors. Like I think so. So this is why a lot of people are excited about both entrepreneurs and investors. So and that's true, meaning there is it's a great industry on the one side. On the other side, because I also do some other sectors, like I did a lot of e-commerce or do a lot of e-commerce stuff, I have never seen more bullshit, than in the fintech area as well. So it's extremely day and night. Or
like give a good example. What's some bullshit that you've seen?
Power.
No single companies, I guess. But for example, I think the whole robo-advising stuff is so exchangeable, meaning a lot in the B2C sector. There is a lot of insurtech stuff, a lot of robo-advising, where I think, there are some smart apps, in the true sense, where I say, it's a nice idea, but kids, it's not a business model. You will never earn standalone money with it. For example, what I do at the moment, that's one of my favorite topics, I try to buy large client bases, existing ones. So I try to buy existing banks, for example, retail banks, or I did, and then put technology on it, because a lot of these things I see, they make tremendous sense if somebody is using them on an existing client base, but they don't make sense standalone as a standalone business model. So I would claim almost all robo-advisors will fail, and some of them will be picked up very cheaply by banks and then be integrated as one of multi-services that banks offer. So my prediction is that in the fintech world, it will not be so much startups destroying the established banks, but it will be the smart banks who will use technology. They will eat up the dumb banks.
And actually that will drive the acquisition trail, right? That's the key. That's some of the key fintech success stories will be the ones that can find the right bank partner to combine their useful technology and distribute that into a strong customer base. And I think that's what you've done in the past, and I think that's what we will do in the future, right?
Christian, let me also ask you, though, since you've been a participant both in the more traditional parts of financial services and the new, do you agree with what I was saying before, that a lot of the large existing institutions really are somewhat significantly disadvantaged by the current state of their tech infrastructures?
Well, yes. This is one of the problems, but can be also one of the opportunities, because the problem with a bank is once you run a bank, yeah, then, and meaning over years, no matter how modern you are today, in some years you will be old-fashioned. That's always a problem because, and the problem with a bank is you cannot just stop it for 4 weeks and make a refresh of your infrastructure. So especially, and then when you have the big banks, they have not one infrastructure, they have like, yeah, multiple of puzzle things together. Yeah, so that's indeed their disadvantage. But on the other side, if you're willing, I think it's more, meaning it is a problem, but it's also, again, it's an opportunity because they have the clients, yeah, and they have the regulatory understanding, which is a really important point, meaning people underestimate, because most fintech startups try to avoid regulation, which will not work anyway, because either this will kill you because you try to avoid regulation, or latest when you're successful, you have to be regulated anyway, yeah, and then you have a problem if you have not dealt with regulation at the beginning.
That's a great point.
So by coming to the banks, like if you take Santander, for example, yeah, they're doing it pretty well because they have a family who controls it, who has the willingness to digitalize the bank. Yeah, I think it's not so much about the ability to digitalize existing banks, it's more about the willingness. Yeah, so you need somebody. So this is why I, for example, buy banks, and because once I own it, I can enforce digitalization on it.
Fascinating.
Yeah, so while, of course, some of the very big banks, like Deutsche Bank has no, to name it, yeah, as although they're actually also pretty fancy at the moment because we serve them. So but I think any other bank, some of them are really like they have not the leadership who wants it or who really realizes it, and they will suck.
What do you think about Bbva? Do they stand out in any way to you? Because that Gonzalez, who's the CEO, who I happened to have interviewed one time, yeah, made a very strong case that they have taken that painful step that you described before and stepped back and basically redone the whole, and you're saying that you agree with that.
Yeah, I think I would see Bbva as a poster child for exactly that. So they've done two things. One, they didn't wake up one day and they didn't decide that they wanted to be a digital bank. Right. They went through a digital bank transformation process before anybody else was doing it. So they're ahead of that curve completely. They've also made some fantastic acquisitions of just the type of things we talked about before.
Simple here in the US.
They made Simple here, which is a great thing. They bought Holvi, a commercial banking proposition out of Finland that is building upon all of those things. They've hired entrepreneurs from outside of the space and given them a real remit to go and deliver that digital transformation initiative across the whole thing.
Yeah. One of the things I just find Bbva so fascinating because Gonzalez was formerly an IBM programmer himself, and now he's CEO of a global bank, and he's like 73 or something. He loves it so much he's not even quitting. But anyway, the point you made about regulation is also a great one. I've heard it said in the US that the real competitive advantage is just what you said. The understanding of regulation is what really keeps the big banks protected. And because, as we said before, it's an even more regulatorily confused landscape.
By the way, to add or a little bit correct what you said at the beginning, Europe is unfortunately, yeah, and the Vice Minister of Finance of Germany is here, he should change that, but Europe is not deregulated, unfortunately. But the good thing is in Europe, we have one regulation across Europe. Yeah, but that regulation is pretty regulated. Yeah, so we're not deregulated, but we're
you're harmonized.
One regulatory environment.
Harmonized would be a word I would use. Okay, now finally tell us what Curve does.
So to tell you about Curve, especially because the space in Europe is very different than space in the US, I'd like to take a short journey of understanding what a bank is. So a bank started about 500 years ago, 600 years ago in Florence, and they received a very simple mandate from the regulator, which is to deposit and leverage funds. Banks are the fuel station of the economy. Without banks, there is no economy. And little by this mandate that you went once a week depositing your salary, they created a unique relationship with the user, with the customer. And from this unique relationship, they start to create a portfolio of products, anything from lending to credit to mortgages and Forex. And this is what you know today as the bank. The bank by itself, to become a bank, the only reason you want to become a bank is to provide depositing and leveraging services. All the rest are not really a bank. To provide lending, I can be a fintech startup. I don't have to be regulated in a sense. I can work with a provider on the back end which is regulated, and I can be very technically and provide you a lot of data scientists and data arbitrage to provide you a better cash flow deployment and managing your risk better. So if you understand the second role of the bank is basically to provide you accessibility to everything money. So put the deposit aside, Without the bank, I don't have access to various myriad of products that exist in the market. What happened in the fintech space in Europe for the past 10 years is that the regulators saw how powerful the bank became. Banks have been so powerful, they were the only reason for the 2008 subprime, and it started in 1928 with the Black Monday. That I don't know if you remember, but probably your grandfathers remember in the early days of the States. So to basically take the power of the banks down, the regulator in Europe was very proactive and introduced new regulations that decreased barriers of entry and allowed companies like ourselves to introduce new services that provide you better lending, better mortgages, robo-advisors in some ways, and different credit lines. But the problem that has been created during these years is that as a user, I'm not even aware of this host of services. I'm aware of some, TransferWise if you heard, or Cabbage in the US, or Betterment to understand your credit scoring better and get offers. But as a user, I have no ability to know what are the other 400 services that exist and access them. And even if I knew, how many services can I manage as an individual? I already have 4 or 5 cards. I'm using PayPal, I'm using TransferWise. That's about it. And if you're a business owner, you already have the business card. So the problem that exists in the market today, although there is proliferation of companies and they're spectacular companies that's solving great pain points for niche audiences, you don't have access to these companies. And these companies cannot acquire customers. This is why Christian mentioned that banks are very powerful with the relationship to banks. So what Curve did is actually created a platform that allows you to connect you to everything money. The way we do it, we consolidate all your bank cards into one. So you have one card and an app similar to Apple Pay that allows you to pay everywhere by just changing the cards you have. This allows you to see all your transactions in one place, and this allows us to get a data network effect and share it with your permission with other service providers. So if you want to buy something with installments, you can just go and buy this TV, and instead of paying $500, you'd pay $550 in 5 installments. If you want a credit line, you just apply for a credit line. The different providers will see the data package, understand your worth, and deploy the cash for you on the best risk base and APR you can think of. So the next bank solution wouldn't necessarily be a true bank, because the banks are doing a great job for depositing and leveraging funds. What it would be, it's a platform that will connect you to all this host of services and will provide you with access based on who you are and how you spend your money.
How are you doing in the marketplace? How many people are using it?
So we're quite a new product. We started a year and a half ago. We launched out of stealth just 2 months ago. We managed to get over 12,000 signups in those 2 months.
You're one of them, right? Didn't you have a card? Did I hear that?
I do.
Yeah,
yes.
okay.
I am the service provider, so.
Yeah.
You are a service provider. Okay, so you carry a lot of cards. Okay.
And the beauty about the product that you see is that unlike any other product, I'm not asking you to change your behavior. I'm not asking you to have a new bank or a new card or to deposit your salary with a startup. You keep using the same cards and services you've been using before, but now everything is onboarded as a layer on top on a mobile-first platform that allows you to use it everywhere. There is no infrastructure, no behavioral gaps.
Christian, you're not an investor in Curve, or are you? Are you an investor in Curve? No. Okay.
I'm not biased.
Okay,
not
good.
yet.
Because I'm going to ask you a question. You're involved with them a little because you're sort of, but we were talking downstairs about this issue of the proliferation of services and the inability for consumers to gain awareness and access, and that it's one of the reasons why perhaps the bubble is not a crazy word to apply to this space, because there's way more services than could ever be adopted. Do you look at what he's doing as an example of a way to cut through that's intelligent, and how do you assess what he's doing?
So first of all, I really literally learned now about it. Yeah. So and I really like it. I'm not saying that because I sit next to him and he could hurt me. Yeah. So I really like it. But I was already starting to think, again, do I have a client base where I could jumpstart that? Yeah. For example, I just bought an IFA company, like what is here, Charles Schwab or whatever, or the Merrill Lynch network, and they have 16,000 employees and 1 million clients. Yeah, and if you would use that, you could immediately bring a lot of cool products to those clients. Yeah, so yeah, I like it.
Dominic gets a commission though if that deal happens. Sorry, it's not Dominic. You look like Dominic. Where's Dominic? He went away. Sorry. I want to get back to this profit issue because I think it's an interesting one. A friend of mine, Rana Faruhar, who's a business columnist at Time Magazine, has a new book out, just coming out, called Makers and Takers, which is very, very negative about Wall Street. She casts Wall Street as the takers in the American economy, taking way more than their fair share of American productive assets. And one of the statistics she has is that Wall Street and financial services generally in the United States represent 6% of total employment, but 30% of total corporate profits, which is a pretty interesting statistic. It's not in itself, but it shows we know those companies can make an awful lot of money, right? And I think as consumers, most of us would say we'd like to see them make less because I doubt if there's too many people here who feel they are treated lovingly by the large financial services providers. So, I don't know, I'm just curious whether in the profusion of companies like Curve, for example, and I think you're understanding my question here by your nodding, so I'll let you give me a chance to escape from it. Will fintech companies be profitable at anything like the levels of existing financial institutions when they're doing well? Or should we just accept that a more digitized, efficient, consumer-friendly financial services landscape, which is, I think, where we would all say, in general, we're headed toward, will be less profitable?
That's a pretty big question. I think it comes down to two things. Profitability is a direct result of cutting your costs across a high revenue position. I think a number of the fintech propositions out there, their lifespan will not be towards massive profitability unless they are absorbed into a wider financial unit and assessed that way. I think a better conversation is about the value and customer relationships and therefore revenue that they generate. And I think that's an area whereby we can measure them and measure the success of fintech A versus fintech B versus fintech C. And I think if we look at it that way, I think a lot of the common practices and principles of what makes good businesses apply just as much to fintech as they do to e-commerce, to retail, to traditional banking. So how cheaply can you get your customers? How much value and lifetime customer value can you generate from each interaction? And how can you deliver your costs and your technology as cheap as possible? If you can solve those three things, and the fintechs that do that will be the ones that not only create value for us as an investment community, but actually create customer value and become more of a maker than a taker.
But one of the big things that consumers want in all businesses these days is transparency. David Kenny, among others, was talking about that on stage earlier today. Financial services institutions generally are very poor at transparency. And I would think, you look at a lot of more entrepreneurially led, even fintech companies, at least the ones I know in the US, they're much more willing to be transparent. And as a result, I think their profits are going to have to be more hard-won, is all I'm saying. But Christian, this is an area where I'm sure you would, okay, did you want to jump in? Go ahead, and then we'll get to Christian.
So if you look at to understand the answer to this question, in my belief, you need to understand why there are so much margins in the financial space. And I believe something that comes to mind is first, you are de facto a monopoly. Once you're with your bank, the chances of you leaving the bank is very, very low. So in a sense, they're a monopoly. This is why they can afford themselves a monopoly in accessibility, a monopoly in the relationship. They can afford themselves to take these high margins. The second point is, as you said, transparency. And obviously they're not, because in a sense, they're a monopoly. If you look at all the verticals of the space of the internet, when the internet came into each and every vertical for the past 20 years, it created two things: a transparency and a planned level of sophistication. So it cut the middleman, it cut down the cost because there's no longer a middleman, and it improved communication between both sides on the table, Amazon, eBay. And once you create this kind of planned level data changes between the bank or the service provider, the fintech company, to the user, immediately the margins will decrease. It becomes more sophisticated market.
Do you want to say something, Christian, about that?
Yeah, so I would say, first of all, the same, fintech companies can be very profitable. Yeah, yes, on the one side, they might have lower margins because they are better for the customer, but on the other side, they're way more efficient doing what the bank's doing now. So practically, I think the cost savings on the fintech side, like on the infrastructure side, whatever, are higher than the lower margins are. So, but bottom line, they're going to make more money. So all the good fintech companies I've seen, I would actually even claim, so one of my, to be fair, super simplified rules is, but if I look at a fintech company and they're not making money within the next 2 or 3 years, something is really wrong. Yeah. So and there are still some like, oh, I make money in 10 years because they can say that, yeah, in other industries. But in fintech, yeah, if you get it right, you will make a lot of money pretty quickly because the margins are high and you're delivering a virtual product. You have not the problems you might have in e-commerce, like you have no storage, no logistic. Yeah, it's a very good business if you have the right product.
Okay, I want to hear audience questions and comments in just a second, but before we do, I'd love all three of you to let's step back from this somewhat more industry obsessive tactical way of thinking about financing companies and who's starting and not and who's going to win or lose, and look at the landscape that is likely to emerge for the consumer, the citizen, the banking and financial services customer of the future, and outline the world you see that will probably be able to emerge. What's the best case for what kind of financial services landscape we're going to have in a few years? And you can pick however many years you want to project out. But why don't you start, Christian?
Good question. Well, maybe I start with something else or in the same category, what I would like to see, and a little bit cynical, because you said big banks are not transparent. Yeah. So I think that they seem to be not transparent because most of the consumer are not thinking about in detail what they're doing. So I see the fault, if you want to say it that way, a little bit with the consumer because they're using, and it's not now a new thing, they're using financial services in a really ignorant way. Yeah, meaning if you're sick and you go to a doctor, you think about it and you want to get the best doctor, but they're not willing, and financials, you have to, as a consumer, you have to understand what you're doing. And the shocking thing is, after 16 years of investing in financial services companies, that most of the consumers do not know in detail what they're doing. But I cannot enforce transparency on them. It's actually them who need to get a little bit more literate on financial services. So, and what I see is that a lot of fintech startups, and by the way, now as a capitalist, to be really fair, are not changing that. They might be better in phrasing that, but take most of the lending companies, and I do love lending because you make a lot of money with it, but a lot of them are, again, not taking advantage that the people not really understand what they're doing. Yeah, so the wish would be in a utopia that the consumer should get more literate and more knowledgeable about his finance.
Maybe the entrepreneurial opportunity includes an educational component that isn't sufficiently being,
I would be a really big proposer. We need, how you would call it, like economic or financial services as a subject in school.
Economic financial literacy.
We train children.
There are a lot of startups trying to think about that.
But if you think about what we learn in school and how much it would change the life of many people if they would learn a little bit about financial responsibility, that would be a real good thing in the future.
Quickly.
So very quickly, I completely agree with Christian here. There's a low level of education there, but it's hard for me to believe that it will change anytime soon. In fact, what I think it has to be delivered to the user on a gold platter. So the future is, think of Apple Pay 10 years from now, where you can use it everywhere in the world with your existing banking partner. This Apple Pay will connect you to everything money. And whenever you need a loan, they will give you the best rate because they will have all the knowledge on who you are, and they will deliver that to the banking partner, which deliver you the best rate. So you won't really have to think about it because people don't like to think about money. People's relationship with money, whether you have a lot of money or you don't have money, is the same. You don't like to handle money. You like to spend it. You don't like to handle it.
Okay, I'm going to try this because I heard it work before. See? Wow, that's amazing. Okay, Jack.
Actually, I think they both said it very, very well. I'd probably take a very simple part that's a bit of both of what you were saying. I think there will be a number of different relationships in the future in a consumer's life where they make financial decisions. It isn't, I just go to Bank X and I get everything from Bank X. I'll make a lot of different decisions. So we will de-commoditize the financial space in the future. And I think by proxy, we will create more financial education in the consumer. So I think that's kind of both what you were saying, but I can see that happening just by virtue of the fact that there will be lots of providers and not just the bank your dad banked with.
Okay, anybody have questions or comments? Okay, hey. Rick, do you want to just use my mic?
Are you familiar with a company called Xero? I'm curious
Yes.
what you think about how that fits into the fintech picture.
Okay, somebody quickly define it.
Yeah, so Xero, to those who don't know, is an accounting system. You upload all your accountings connected to your banking system, and you basically do the reconciliation of your accounts every month. It's like your online virtual accountant. So Xero, like many other fintech companies of this caliber, they're also thinking of rebundling the fintech space, but they chose a different approach. They chose the approach of everything starts with data. It's all data arbitrage game in the fintech space. The more data you have, the more efficient you can be, the more delivery of deployment of cash you can do. What Xero did, they basically said, I will gather this data, I will focus on businesses which are more lucrative and easier to acquire in a sense, you know where they are, and I will focus on this data to capture that through their accounts. And once I'm there, I can help and connect companies like Fundbox and allow them to deploy cash on advanced invoices before. So there's different approaches to the vision of rebundling the space. Xero is one of them through the accounts. Xero, FreshBooks, QuickBooks, SAP.
Yeah, I think they're a classic ecosystem business, right?
I want to get a few more voices in. You're going to just have to shout. Stand up, though, if you would. Oh, okay. You don't have to shout because
Thanks, David.
I'm just too lazy to do that. So.
You started out this session by talking about how most of us don't have a very warm and fuzzy connection with our banks and retail banking. And I'm curious in part because I tried to pay someone I know with Chase QuickPay or PayPal recently. And while I use Venmo a lot, the person actually brought up the fact that she hated that she couldn't do the fun things you could do with Venmo and the emoji, kind of the intangibles. I'm wondering how important is that? And is that something true outside of the US?
I think what comes before the warm, fuzzy feeling is trust. And I think at the point by which you can deliver a trusted service, at that point you can add the value adds and the emotional experience on the top of that. But the reason that you went to Venmo, PayPal, Chase first is because you trusted them to physically deliver those funds, right? I think that's the battle that some of the fintech companies have first, is to deliver that. I think we'd all take guarantee of funds over an emoji any day of the week, right?
But on the other hand, you know, look at what Jack Dorsey's done with Square. I think one of the things he's tried to bring to that service is a softer side, as a, you know, just a more friendly way of thinking about how you interact with money. Even, and that's a whole longer story, but I think it's been rather successful. Go ahead. Just here. Okay, I will jump down.
Awesome, thanks. Hey, Christian, you made a point earlier. Is it a product or a feature? Or is it a startup or a feature is probably a better way to say that. That's something we think about in the fintech world domestically. I mean, how should we be thinking about that? And couldn't you make the argument that anything that we build from the startup level could be a feature integrated into a bigger monster?
Well, any feature can be implemented in a bank. Yeah, the question is, will the person or the company who has developed the feature get a share of the pie? Yeah, so, and this is why I think a lot of these companies I think will end up, they're not worth less, but they are worth not a lot, because at the end, if you run out of money because you don't have a business model, somebody will say, oh, I just did that with one company, said, you have a really nice app, but that's maybe worth 500,000 euro, not the 10 million which somebody else paid you as a valuation, yeah. But hey, you spent the 2 million you got at 10 million, you spent really nicely, and I take it now for 500 and apply it on my customer. Yeah, but they don't have a share in it. Yeah, and you need to really, or a startup company needs to really think what is their, how strong is their position to either, meaning there are some standalone B2C business models. I'm not saying there are none, but there are less than are fundraising at the moment. Yeah. So you need to think, can you be a standalone B2C business model, one version, and there are ones, or do you have a product which is so strong that you can sell it as a B2B service to multiple banks, yeah, and make money? And by the way, so if we would go into details, the time is running out, but I think a lot of the fintech business models, the really ones I see are way more complicated, yeah, meaning then they might be showcased at a conference now, yeah, because always like a little bit that there's a tendency that always the cool, simple stuff is highlighted because everybody is understanding it right away. Oh yeah, this is a robot buys it, it looks very cool, yeah, you can present it very well at a conference, yeah, but I could I did one company with Peter Thiel together in Germany. It's like a total new platform for savings deposits. Yeah, it sounds pretty unsexy because savings deposits, whatever, but it's a $9 trillion or €9 trillion market. Yeah, yeah, but you need to understand the problems of the savings market as it's now in technology terms, whatever. Yeah, which is not a household problem. Yeah, in order to understand how cool that company is. Yeah, so you know what I mean. So yeah.
We got to wrap. We are over time. I will say it's too bad we didn't have at least one American financial services entrepreneur on this, because the problems here are very, very severe and quite different. I mean, it's just astonishing how bad the financial situation is of the average American, and we need innovation to help with that. I just hope that Christian and Shachar go do a deal, and I hope you'll all come to Techonomy New York. If you're interested, speak to me, and I know Steffi wants to get on stage, so thank you all. I thought it was a good discussion.